Today we're going to be talking about stocks and placing your first trade. Hello, I'm Michael Robinson, host of the Michael Robinson Show here on Microbin Radio every day. Also, entrepreneur with over 3 decades of experience running companies on Wall Street and author of the book 100 Pennies. On my shows, I share with you strategies about entrepreneurship, career advice, and investments. Today we're going to be talking about stocks and how to begin trading with the big guys on Wall Street. But you don't need to go to Wall Street to do it. You don't need to hire a broker. You don't need to sign any major forms and go through hoops to do this. There are platforms available, platforms that allows you to trade right from your home, right from your smartphone. One of them is called Robinhood. Robinhood is very simple, very easy to use, and for someone starting out for the first time, I highly recommend it. It also allows you to paper trade. So if you want to sort of get your feet wet without using your own money, Robinhood is a good alternative for trying the stock market. The other platform that I absolutely love and use continuously is TD Ameritrade. The reason why I love it is because it has a lot of bells and whistles and tools that helps me to make better decisions about whether I'm going to buy a stock and when is the right time to sell a stock. It has wonderful graphics and a layout that's just very, very conducive for accessing information very easily on one page many times. There's also an application, or actually it's a platform that allows you to use the software on your computer. It's called Thinkorswim, and you can use it as a web base or you can use it as an application. I do like the application a great deal. Before we start talking about stock investments and how to place your trade, it's important that you know these softwares because it's kind of like going into a bank, right? Each bank is different, has a different setup, it has a different structure, but the banking process is the same. If you want to deposit a check, you go to the teller, you fill out a form, deposit ticket it's called, you sign the check, you give it to the teller, and you deposit your money. Likewise, if you want to withdraw money, it's a similar process, right? Filling out the form, giving your ID, and getting the money. Or going to an ATM machine. Most banks have ATM machines these days, and doing the process that way. Well, think about it. When we trade in stocks, it's the same sort of setup. The process is the same, but the banking structure may be different. So one bank may have a lot of information available to you right there. You see all of the rates of the CDs and the money market, the price of checking, and all of the bells and whistles that they offer. It's right there available for you. While in another bank, you may have to ask questions, you may have to look around the corner a couple of bit, you may have to try to figure out how things are done there compared to other banks. So some banks make it easier for you, while other banks are a little bit, more complicated. So a lot of the software or platforms that are available is sort of like that. For example, I like Robinhood because it's very simple to use. You log into the software, you put a name or a ticker symbol of a company that you might be interested in, and it pops up with the price point. You see the going market rate of that stock in that time. And you also see what the high points are or the low points are based on the graph. Sometimes it gives you enough information to allow you to make good decisions about the stock. Now, when it comes to trading, it's pretty much the same across the board, no matter what platform you're on. There is a buy portion and a sell portion, right? So if you're buying a stock, what you're buying is the price of the stock, either the market value or a limit order that you set. A limit order allows you to choose how much you want to pay for that stock. So for example, if the stock is trading for $2 and you want to set a limit order for $1.90, providing the stock is volatile and goes up and down, chances are it will hit the 190 target before the day is over and your order is executed via that platform, via that strategy. So limit orders are great because it allows you to kind of come down a little bit on the price, see what the market is looking like. And if you find that the market is moving or trending upwards, you may want to go up on the limit order if you feel very positive about this stock. So you might want to cancel the order or edit. See, in Robinhood, you cancel the order and activate a new order. In TD Ameritrade, you can edit the order. So if you want to edit it from 190 to say 198, you can do that without canceling the order and it's executed for you. So each platform has this wonderful ability to allow you to make adjustments based on what you think is good for you in terms of trading. So let's talk about the actual strategies for placing an order. Obviously, you have to think about the price point. You want to think about the number of shares you want to purchase. And then you want to think about the process of execution. Do you want to pay market value for the stock? Well, unless you feel the stock is running at an amazingly awesome price point based on trends you've seen before, the market value is good. But most people don't use the market value unless you're really absolutely interested in securing that stock in that price point in that time. The next opportunity is the limit order, as I mentioned. The limit order allows you to put a price point in a little lower than the market value. If you look at any of the trading graphs, you'd see how volatile some stocks are. Some stocks can be flat for a couple of minutes or an hour or two, while others can be trending up and down consistently in a matter of 5 or 10 or 15 minutes or an hour. So some stocks are more volatile than others depending on what's happening with the company, depending on what's happening with the market, while others are a little bit more relaxed and stable across the board. So the limit order allows you to put a price in to buy the stock when it reaches that price point. The next is a stop loss order. Now the stop loss allows you to place an order in and prevent you from losing too much cash if the stock begins to trend higher than you anticipated. And there's a stop loss limit order, which also works because it limits the price point that you want to pay or you want to go in as far as the stock is concerned. And the order is executed when that stock hits that point. And then there's a trailing stop order, which can either be based on a percentage or a dollar amount. That allows you to trail the stock as it goes, and if it goes outside of your price point, then the order is triggered based on the actual amount that you have indicated to the system. So the stock market is actually very simple to navigate when it comes to placing an order, when it comes to selling the stock when the time is right. It's just a matter, the most difficult part is learning when to enter or when to buy a stock and when to sell that stock. And also you want to think about this, is it going to be a long-term investment for you or a short-term investment? For example, a lot of my investments are short-term. I place my orders and sell within a month, sometimes in a week, depending on how the stock is trending. And what it allows me to do is sell the stock at a profit and reinvest a higher amount into another stock, or maybe even that stock when that stock goes back down to a price point that is, in my view, profitable. But I need to see what's happening with the company's financials. I need to see what's happening with its quarterly earnings. I need to see what's happening with its shareholders or managers or the economy, whether that company is thriving in this economy or if it's slowing down or a potential for slowdown is happening. Is the stock overvalued? Is the stock undervalued? All of these things are very important when it comes to making a decision on whether I'm going to buy the stock or not. Also, I want to look at the profit and loss statements. I want to look at the value of the stock based on the P&L, based on the margins. These things are very important because the cash flow is another thing that is important for me because it gives me a sense as to how the company is spending its money, managing its money, because sometimes financial statements can be overinflated and thereby giving the investor the wrong numbers. So when you look at different spectrums of the financial statements like the cash flow, the P&L, the balance sheet, these things give you a kind of a broader spectrum as to how the company is doing and how the stock can grow or not. Are there other companies that are investing? Is the company looking to grow more? Is the company has it gotten a new order for, let's say, 50,000 products or 100,000 products based on the size of the company? All of these things impact the dollar value of the stock. And therefore, you want to pay attention to it. You want to pay attention to the news when it relates to your investment. All right. So I hope that was helpful to you. Don't forget to subscribe to my channel by clicking the bell, giving me a thumbs up if you like what I'm saying, and feel free to ask any questions or provide any comments. They're always, always welcomed. And you are always welcome to join me here on my show to talk about stocks and investments. Tell me what you're doing. Tell me how you're investing and how that's coming along. I really want to know. All right. I'm Michael Robinson. Remember, this is your time. Use it wisely.